my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Another quiet or quietish week as the market sat within the congestion zone, made up of the lesser Fibonacci levels at 1400, 1389 and 1378. These three have halted any falls in this market since late July and actually held up the market in August, September, start of October, and last week and this week. They have kept beans in the teens. Please remember those levels: 1400, 1389 and 1378. They keep turning up. All this action since August has a possible descending triangle, with the upper trend line being the mid-August to date downtrend, currently at 1437, backed up a little higher up by the paralleling and declining medium moving average, currently 1453. Whilst below, we have those same levels of 1400, 1389, 1378 acting as the base of the triangle. And here with the August also 2020 to date uptrend, currently at 1367, rising up to meet it as a possible if unlikely bank of support. This triangle has a limited lifespan. It will be over by the end of November. In the meantime, the operational area between the trend lines will be narrowing all the time, and the chances of a false break in either direction will be increasing. I can't say yet which direction the break will take, but I can give some idea of the size of the break if this pattern works through. If the market makes a confirmed break above the downtrend line, then the primary target area of such a move would be $1.15 above the confirmed break level, and the secondary harder to achieve target area would be $1.75 above the confirmed break level. A confirmed break lower would have a primary target 87 cents under the confirmed break level and a secondary target zone $1.75 under the confirmed break level. Of course, this is just for this pattern, if it remains a descending triangle and doesn't turn into something else. Chicago soybean meal. We have had here for a number of weeks and continue to have different patterns sort of hitting off of each other at the same time. The immediate pattern has been the May to date seemingly broken but not yet quite broken, then not quite broken again, ascending expanding wedge pattern, something I pointed out many weeks ago. This has developed, currently 407.90 to 487.60, though it is not a perfect pattern. But the latest breach on the downside, yesterday's counter to the counter key reversal down, which has not had any follow through lower today, is symptomatic of the heavy intraday indecision we've seen in this market since the start of October. Interestingly, the base of this pattern is the neckline of another pattern, the huge December 2021 to June 2022 head and shoulders continuation pattern, currently 407.90. This second earlier pattern had been a signature pattern here since last year, and you can see how it resonates even now. It has the unusual though unique feature, of a head and shoulders top over February to April, crowning the head of a bigger head and shoulders pattern. Going back to the neckline, this shallow uptrend had also been the base of a quad and arguably a quintuple bottom, so a break below would be a very interesting vision on that level as well. Anyway, the key obstacle on the downside was, still is I suppose, the 50% Fibonacci line of the October 2021 to March 2022 move at 400.50. This despite two recent separate instances of consecutive closes below it. It is still managing to wangle itself as a support. My earlier thoughts on tackling this support were likewise not complimentary to any attempt lower. I quote, "Well, good luck with that. The market has tried that a total of 6 times so far since May with no result. I'd just keep an eye on the parameters of the ascending expanding wedge pattern, as that seems to be the key here." End of quote. We are, as of today, up to 9 individual attempts, not days, but groups of days bundled as attempts, 9 individual attempts lower, and so far not making it. I nevertheless still continue to have a suspicion that the current move lower might be, in the end, be successful. Beyond the 50% Fibonacci line at 400.50, I have another 50% Fibonacci line lower down at 386.80. This seems a reasonable area to look at next on the downside. I'd previously placed some ideas on the downside. Thus, for an ascending expanding wedge pattern, the primary target X would be in the 367 area, a zone, and a secondary harder to achieve target X1 would be in the 342 zone. These are big numbers to think about, and they are based on the move lower being a genuine one and not a false break, unlike what we have recently seen. So with all those caveats, these are the opportunities below. It will now be interesting to see if the market follows through. One new and final addendum: the action over October is now suggestive of a small sideways triangle, or if you like, a large pennant pattern, currently 397 even to 411.60. This pattern has a half-life of the descending pattern idea, running out by the middle of November. So it'll be interesting to see if this smaller pattern gives a clue to the larger pattern. Chicago soybean oil. The key features that happened since my commentary last week were last week's weekly key reversal up and the construction of a bow tie formation last Tuesday between the rising short moving average, currently 67.10, the gently rising short medium moving average, currently 66.28, and the declining medium moving average, currently 66.03. This is not a perfect bow tie formation, as the medium moving average was, and is, still heading lower instead of higher. However, it is worth considering, especially in the light of the weekly key reversal up last week and the subsequent action this week, especially the market moving above the rising long moving average, currently 69.57. So, in a bow tie formation, not only does the market have a tendency to move in the same direction that the moving averages exited the bow tie, in this case mainly higher, but after 15 to 20 sessions after the crossover, that is between the 15th to the 22nd of November, we should see the start of a major move in the next direction of the market. Again, mainly higher, as indicated by the majority of moving averages moving upwards. Okay, so I hope that is all clear. Other than those two key and related points, we have seen this past week the market move above the lower tie, currently 69.09, of the December 21 to June 22 bullish Andrews pitch hawk, under which the market had been hung like so much washing as the tie rose since late September. The latest resistance that the market is challenging is the June 2021 high at 70.33, which had successfully capped the market back in late June this year. That's this year as well. Then also mid and late August and again in mid-September. So it is a significant resistance that is being tested. Beyond that is the untested but I suspect important 50% Fibonacci line at 71.97 of the whole of the 2022 move. One final point I'd like to discuss, and that is something I pointed out in recent weeks. I've had a suspicion that the action since June may be culminating in an extended V-bottom pattern. An extended V-bottom pattern is much like a regular V pattern, such as you see anywhere else, but has an extension, such as a bull flag or some other form of congestion, much as we've seen here. Extensions may happen before the V as well, but for this particular market, we'll look at it happening post V bottom. Thus, it would not be surprising to see this pattern, should it continue to see a move up to the 74 even area. Given all that has happened, these actions negate the monthly key reversal down we saw in September. And if they don't, then a move up to the 74 area most certainly would. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investors Services International Limited. And here comes the final bit.